Hey everyone, welcome back. Thanks for joining here. We're going through understanding the market. So this is part two. You can see part one that is uploaded in our educational section there as well. So this second part is we're going to be taking our understanding of the mechanics of the futures market that we've already gone through and identify some simple tips to understand that movement of the market and how we can create a strategy from it. So let's dive in. So a little bit of an overview, what drives the futures? So we know market expectations. So futures are driven by the expectations of supply and demand for specific commodity or even commodities as a whole. As we know, there's substitutes. Cash is king. We highlighted this a little bit in part one, but we really want to hit on it. The cash market will always rule for the strength and weakness in futures, right? So as much as we know that sometimes it might separate a bit from what the cash markets are, it'll always be relatively reverting back to what is actually happening in the cash market and what is going to happen in the cash market. Timing differences, we talked about traders want to get ahead of cash market movements to profit or expand margins, while, hedgers, cash markets are positioning against maybe the expected futures market as well to ensure that their cash is covered. So why do we say cash is king? So the majority of futures for the ag complex are traded from hedgers that are engaged in the cash markets. As we talked about in part one, hedgers are people that could be buying products from the farmers, producers, and selling, going short the futures, or they could also be something like we used the wheat mill in the example that is needing to buy the cash in the future, so is buying the futures. So they trade their futures that are aligned with their cash intentions. So think about it from the farmers. As a farmer, you won't really sell at low prices, right? But as prices start to rise, you and other producers would probably have some relatively similar selling prices because cost structures, as a whole are similar. And so when you get up to that price with the futures and you sell it, there's a wave of selling. So the grain handlers who are buying that physical from you are then hedging themselves by selling futures. This selling pressure can put pressure on the futures, right, and push it down. And we also can identify that if open interest is increasing while prices are decreasing, right? So that's new positions that are entering the market, and that's that hedge pressure. And that's why we really talk about that cash is king. So the key driver is the supply and demand. And we talked about previously that speculators are in there to arb in the market and they're trying to capture, different moves, whether it's technicals, daily, weekly, or on long term, but they're also using the supply and demand because if you are going to be short supply against your demand, prices need to rise up to a certain point. If you have more supply than you do have demand, prices need to come down to trigger that additional or incremental demand, we'll say, right? So that is what's going to be continuing to drive the futures. And that's why we focus that cash is king. What are the actual users doing? The wheat mills, the crushers, the feeders, the grain handlers for export, that sort of thing. Those are going to be the drivers rather than a speculator that's necessarily just in there maybe for daily, weekly technical trades. They're probably going to be doing that, but they're also looking at supply and demand because cash is king. So the two key principles, cash is king. The physical markets are ultimate drivers of the futures market, right? So traders try and predict price movements to capture margin. The direction is going to be ultimately determined by what the reality of that supply and demand in the physical world is. And that's why every month those WASD reports are so important, not just to the US production, but also the world production as a whole, because in the end, we are a pretty globalized world, and trade in particular, that what's happening in South America on their corn or soybeans crop is going to have a huge impact on the US corn and soybean crop, or prices, I should say, and demand. Same thing, like if you're up in Canada, what's happening in Canadian canola? Yeah, it's one of the larger ones, but also you need to know what's happening in Europe, right? And that's why these WASD reports are so important, because countries have the ability to buy and sell from different countries. They're not all just tied to one, and prices matter. So the hedgers are driving the market, right? We know the majority of the futures volume is going to be coming from the participants that are involved in the physical cash market. Farmers, handlers, processors, millers, those sort of ones, not just the speculators. So overall, that, as we went through in part one, that collective buying and selling from these different cash markets is what's actually moving the prices up and down for the most part. So that push and pull dynamics, just to highlight here, selling pressure, cash market selling from farmers and handlers push futures down when the supply is exceeding. As we just went through that mini example before, what happens is if you get futures to a certain price that is a really good cash price for farmers and there's good returns, there's going to be a lot of farmers that are selling to those grain handlers or to any of those users. And what they're going to be then doing is in turn selling those futures to hedge. And that's where you can see when you hit those resistance points can be seen as what a cash trigger for farmers are. And you'll start to see the price come down at that from all the hedges that are hitting the futures market. Buying pressure, buyers anticipating higher prices will be buying futures at the lower one to offset any potential higher cash costs that they'll have. That then pushes up the futures. And that's why you can really find resistant levels and support levels or even trading channels within futures, because we see that is what's triggering things in the cash market, right? When margins are there for processors, millers, feeders, when margins are there for farmers to be actually selling their physical, right? That sort of thing. So the market balance, traders and funds, they of course provide the liquidity between the trades, trying to capture that arbitrage opportunity. So they do have their place. So this buying and selling from end users, farmers, it's what moves the market and keeps things relatively equal. How traders and funds provide liquidity in this time frame, and they are essential participants in the middle of these trades. And they're looking maybe for daily and weekly quick arbitrage kind of movements, but they're providing the liquidity, which helps. So we wanted to highlight some cash triggers. Now, this isn't an exhaustive list, so there are other ones, but these are ones that we identified with talking to our mass amounts of growers that are on the SimpleHedge app and platform, but ones that are readily available to the producers at any time, right? So it's things that you can contact with your local buyers and that you can read on that can be really good cash triggers, because we're not the big multinational companies, right? We're producing our crop. That is our space. We're not these multinational corporations that know everything that's happening on trading that's going to be moving the futures. But these are some ones that we can find out from our farm operation about what could be happening on a bigger international scale in the cash market. So the first one is basis changes. So the direction of the basis is important. It is signals to the market of whether they need to buy in cash. We know basis can be positive or negative, right? So a positive basis and a firming basis signals that the cash market is getting stronger. Local buyer space allocation. So some people kind of miss out on this one. Is your local buyer, like a grain elevator, are they allocating space to one commodity over the other? Are you getting more interest for your corn than your soybeans? Are they talking about that they're running a bigger corn program than soybeans? That's a cash signal that the demand is there for the corn and that the margin is there for it as well, right? Last minute coverage. So this one, you can always take it with a grain of salt, but last minute coverage is that grain handler, are they in a wrong position that they're needing to buy in a bunch of product? Have they really misjudged that supply and demand factor or where the pricing is, and is the supply not necessarily there to meet their demand? That can be a good cash trigger, right? To understand that, saying, hey, they're actually really desperate. They may have been short thinking it was all going to come to them. Turns out the market's not that way, and they're trying to get covered in, right? So you again have to take that one though to an extent with a grain of salt, because you need to make sure that it's not just localized to this one elevator, that maybe they just took a wrong position or their logistics just weren't planned properly. Policy changes. Trade-friendly policies create demand, and that will drive cash business. We read in the news the importance about China coming in to buy soybeans. Obviously, if they're going to come in and try and buy 25 million tons of soybeans a year, that takes a lot of supply out of the market. When you're dealing with more demand, that's narrowing in the supply, that helps push up prices. That'll push up the futures price. You could see that also reflected in the basis as well. So these are 4 triggers that we can get from, our local buyers and understand what's happening in the cash market outside of our localized region. So basis change. So if you're seeing a basis firming, this is a signal that buyers can pay up more. And that means that the futures may follow, right? So if you're starting to see maybe a negative basis start to become less negative or even get to even to positive, that can be a signal that there's the demand for that product and that the cash demand might be getting firmer than what the futures are actually following. So it can be a really good signal to say, the futures might end up following, because sometimes cash will start coming to the market, interest will start happening from buyers to the sellers about what their maybe potential intentions are, and those sellers might start increasing their value because they want to get in a better position. They want to start buying it. They want to get maybe in a long position because they might see a huge demand flow. So that's a good signal. You got to be careful though to make sure that this basis isn't firming because someone is in the wrong position and they're just covering a short. You got to be careful on that if that is happening and they are covering a short, that they are thinking that probably the market's going to go firmer, or they just need to get out of a position outright and move on, sort of thing. Basis weakening. Buyers might not need the product, or they're not able to get business done at these levels. So sometimes futures, like I said, can actually move separate from the cash market. And what happens is you end up getting a basis weakening because they're not able to sell the product at what the basis level currently was, along with the futures. So they'll start backing off and weakening their basis. So that, once again, can happen in the cash market before even it happens in the futures, and maybe the futures might end up following, right? Things are oversupplied or the demand just isn't there, that sort of thing. Really important about the basis change though, look at multiple buyers to see where they are. The market will move in relatively unison. So you got to make sure that it's not just your local elevator that is having these basis changes, but maybe you're seeing it across 3, 4 different elevators in your region as well, right? So we got to think more than just outside our own backyard and our own elevator about these basis changes to see what is actually happening in the greater cash market as a whole, to see how that's going to play out in the futures. So the space allocation and the last minute coverage. If your local buyer is interested in one commodity over another, that is a signal they're probably seeing more demand for that specific commodity and more than likely better margins for that. So we need to think about that. Buyers have limited space, right? And generally limited demand. So they're going to try and maximize which one has the most demand and the best margin at every opportunity. And so what happens in the market when there's good margin, everyone runs in to try and sell that margin and capture that margin, and it ends up compressing it, right? So there's that ebb and flow on what can happen through different demand cycles or different demand time periods of certain products. So if you're noticing a heavier shift or a shift in buying heavier or more interest in one product, that is providing a signal that cash demand is there and that it's marginable, right? So you could see that the futures start to follow if they haven't already. That's a good cash signal. The last minute coverage, as we said, so buyers looking desperately for last minute coverage, this can be a signal that they're on the wrong side of a position. So they're short, meaning they're thinking the market could get firmer. So they're going to try and buy in and get out of it. Or, we have to take it with a grain of salt that maybe it was just their logistics. They had poor logistics planning. They need to cover it in just so they don't get penalized on, worse costs, right, from being late on delivering products. So you got to take that one with a grain of salt, but it is a very good one to understand what the demand could be. So last minute coverage, they're giving up margin rather than facing those greater costs from being short, right? What that can also do is more insights that the sellers are not there at these levels. Market needs to get firmer to provide greater seller interest, that sort of thing. So if you have an elevator that's really short for a train, well, maybe it turns out that these weren't great prices to have sold at. And so prices need to go higher in order to entice that, especially if the desperation maybe gets more and more as you go. Policy changes. So we know these are hard to predict, and the futures can move first because the market likes to bet against the potential outcomes. They like to take relatively educated bets, right? So if they really think that something makes sense, greater renewable fuels are needed within the system, that sort of thing, and the likelihood of that happening. So the futures can start to move and try and make bets on that. But trade-friendly policies, that brings cash demand to the commodity and helps drive the domestic or international demand. Again, all this stuff talking around China with soybeans, that helps drive cash demand. And as you get more demand, right, it should start pushing up prices. So signals to watch, rumors about potential demand coupled with changes in the local buyers via bids, available volume, their basis change, right? It's that kind of thing, buy the rumors, sell the news. What you can do is also be talking with your elevator, seeing what changes they're making based off of these rumors. That can help provide you insight into maybe what some of these multinationals might be seeing. If there's a policy change about, say, China coming in and it's actually going to happen, they might start creeping up their basis so they can get in a long position, right? So they can expand their margin. That can be great insight into this big multinational that has some better information than us, that they think this policy is going to go through and that China is actually going to execute on these 25 because they're firming up their basis to try and get ownership. So it provides some great insight into what the buyers are expecting to come on policy as well. So if you want to put it all together, is the basis changing? You got to think about which way it's changing. Is it localized, or are we seeing multiple buyers changing their basis? What delivery months, what futures contracts, how far out is this going? If it's just temporary in the nearby, maybe it's just covering off to a logistics cover off, right? But if you're seeing basis changes, more demand, they're looking at a certain commodity that's going out a few months, hey, that could be a pretty significant demand shift that you're seeing, and that's what the basis can help provide. So if you're weakening, what are some things that you can do with it? Add a put option or sell a future, right? So if you see a basis weakening, that can mean that the demand isn't there and prices can come down on futures. So you want to protect yourself to the downside. Putting on a put option or selling the future, this will give you time to see if the future/cash price move lower, that maybe it gets to a point where they have to bump up the basis because it's moved too low on the futures. So you can capture up on the basis side, but have protected yourself on the downside. Firming, if you're starting to see it firming, do you want to buy back bushels by owning a call on something maybe you've already sold? You can see our re-owning bushels video to understand more about that as well. Then you get into the space allocation. Are buyers interested only in the one commodity? What period is the interest for and how long? And is this a material change from prior communication or against seasonals? Is your local buyer usually split 50-50 on corn and soybeans or canola and wheat, and now you're seeing it go to 75%, 25% on one commodity? That's something to take into consideration and saying, hey, actually, it sounds like there's pretty strong demand then. That's something we need to think about. So identify the demand for one product. Look at protecting with puts or short futures on the one that the demand is less on. So if you're going to see that, hey, corn is getting a greater allocation in your elevator than what you've usually seen or what your buyer has previously communicated, maybe corn's going to go up, and that means the demand might be less for soybeans. So go and protect your soybeans with a put or a short future. The last minute coverage, desperate to cover. Are they desperate to cover? Is this consistent? Are they consistently desperate to cover further out than maybe just in the nearby? Are they getting that covered really quickly, or are they getting more desperate that maybe more phone calls are happening? Maybe a couple of extra little premiums or deals are being offered to you. That can be a signal that, again, on the wrong side of the position, or that the market is flipping from what their position is, right? That sort of thing. So You can sell the desperation if you get some premiums out of it, and if you think it's going to go higher, go re-own the bushels, buy a call option, or go long the futures. You can see how high this maybe desperation gets that they're giving you additional deals. Can you get added basis value and use those dollars to then hedge or re-own the bushels in the financial? Think about that again, the financial and the physical being one thing. Can you get an additional premium on your basis from a local buyer that might be a little bit desperate if the market's moving, and then take that and go in and buy a call option? Sell them the physical, keeps them happy, you're happy if it makes sense, but then use that extra premium and maybe go buy a call option if the market's moving up, right? All ways that you can help expand what your return and margin is going to be in these different situations. So the policy change, you got to review, is it potentially bullish or bearish? Is it a rumor, or is it going to be rumor with legs to it, right? We hear about a lot of rumors, but sometimes there's rumors that, there's some ground to this, right? And this rumor could actually fall through, and we might start to see things changing. Again, with the policy change though, are the three above triggers, basis changing, space allocation, last minute triggers, are these confirming this policy rumors or changes potentially that we're hearing? If they are, then there's probably some good legs and provides you more insight into maybe what these bigger companies are seeing on a national, international scale on that cash demand side. If they're changing their basis, if they're changing their space allocation, if they're needing last minute coverage, that can be a confirmation to these policy rumors, right? And you can then position yourself for it. So we all hear buy the rumor, sell the news, right? You can carry the market up on rumors, put on puts or sell futures once you've got to satisfying levels in the futures market, and give you more time to see if basis change or other moves, but making sure you've protected yourself after the run up for anything that falls off. Once again, the buy the rumor, right? People will run up on rumors, and then sometimes the news comes out and it's not what everyone thought it was, and the market sells off. So that's where that buy the rumor is. Run the market up to the point, get some hedges on, protect yourself for when the news actually comes out, if it comes out not as optimistic, sort of thing. Make sure these other three triggers are confirming that policy, right? You might be able to wait and watch the market go higher, maybe look at some cheaper calls, right? Do you want to sell calls at a certain strike price to increase your selling price as well, right, with this? So if you're looking at soybeans and we're at $11 and China's going to be buying all these soybeans, do you think that maybe 11.25 or 11.50 is the highest it goes? Well, maybe there's an 11.50 call option that you can sell for 10 cents. And if it gets up to 11.50 and you get that 10 cent additional, you've sold an 11.60 equivalent, right? So thinking about these things, putting them all together, don't just look at them individually or separately, but these are ones that we can see just from our local elevator, our local buyers, to get understanding of what could be happening in the cash markets in areas that we don't see, or what's potentially happening and what maybe we would consider some more of the smart money, the multinationals, the big companies that are dealing on international trade, what they're seeing. And that's giving us insight into what that potential cash demand is and how we can position our marketing around it to maximize our return, but also making sure that we're protecting our return on our crops as well. So that's wrapping up our understanding of the markets. This was part 2. Again, if you have any questions, feel free to reach out. My name is Steven. You can email me at steven@simplehedge.com. You can give us a call in the US or Canada at either of these numbers that are on the screen. And of course, follow us on Twitter and Instagram. Thanks very much.